appreciate you all being here so close to the lunch break. Now, in his famous book about trust, in his famous book about the human species, Yuval Noah Harari describes money as the most universal and most efficient system of mutual trust ever devised. It can bridge almost any cultural gap, he writes, allowing people who don't know each other to work together and trust each other to deliver a greater good, including feats of engineering like this suspension bridge in Japan. At the heart of money is trust. Why else would anyone believe that a piece of paper or parchment or polymer these days is worth anything at all? The person that receives a banknote has to believe and has to be able to trust that they can pass that note on to someone else and it be worth the same to them. Ultimately, for a banknote, that trust is derived from the central bank that prints them and devises security methods that ensure that it is very difficult to forge and easy to spot. The central bank goes further too, to ensure that the value of the note remains stable by maintaining a relatively low and stable rate of inflation. Having spent 14 years myself at the UK's central bank, it is ingrained deep inside me in terms of monetary policy that trust is very hard-earned and very easily lost. Modern forms of money are no different. Regardless of how it appears or how it is used, the money still needs to be trusted. When we use bank-to-bank payments like faster payments in the UK, we rely on our bank and the settlement system that connects it to the destination bank to make good on our commitment to pay someone £10. If the bank decided on occasion not to settle that transaction, or the settlement system behind it actually failed, then sending £10 via faster payments simply wouldn't be as effective. It wouldn't have the same value as the banknote, and people would use it less. The same is true for card payments, as well as mobile payments like Apple Pay and Google Pay. Card companies spend huge amounts of money and time monitoring in real time and ensuring that instructions on the card networks are valid and can be trusted. Without that trust, the whole card system would lose its value and its appeal. Because we're used to using those payment methods, we're comfortable with them, and we understand the risks and the benefits. Digital currencies offer us a new way to transact, and they purport to offer better ways. But the core principle of trust still applies. We've seen a proliferation of stablecoins over the last few years. Following the growth in adoption of Tether's USDT and Circle's USDC, as well as the very spectacular failure of Terra Luna's UST, shown here on the left chart, we now see fintechs and banks all over the world issuing digital currencies tied to some nominal value, including SocGen in Europe and including Bancolombia in Latin America. These stablecoins borrow their value from the fiat currencies they are tied to. To manage the financial risk of that endeavor, they need to manage carefully their reserves to ensure that holders of their token can trust in the value of the token they're holding. This became very apparent in March last year. At the moment that Silicon Valley Bank was going bankrupt, there were significant questions over the status of the reserves backing USDC, Circle's USDC, and we saw a small and temporary depegging of the stablecoin, as you can see in the right-hand chart, relative to its par value against the US dollar. But it's not only trust in the value of the currency that's important with digital money. With a new technology like this, people need to be able to trust in the operation as well. And data privacy is core to that, as we learned from Facebook's Libra project back in 2019. When it was launched, it brought home the very tangible risk that a stablecoin could give a sophisticated technology company access to spending and financial data on its 2 billion users. Given the amount of data we already share with these large technology companies, it's unsurprising that people were nervous about sharing even more sensitive data with the largest tech companies in the world. Banks see an opportunity to step in and address the financial risk I mentioned. After all, they've been creating money for centuries, quite literally. So tokenizing commercial bank money and creating what we call tokenized deposits seems like a very natural thing for a bank to do, to maintain their role in the monetary system, especially as demand for digital assets grows. And financial crises aside, those that are still in business can lean on their track record, sometimes over centuries, in keeping resilience and building trust. They also, though, see an opportunity to step in and address that data protection challenge. When asked about who we trust with our data, banks do surprisingly well. Perhaps as a highly regulated industry, it's clear that compliance with data regulation is right at the top of their agenda. My personal theory is that we also trust banks because we know they're actually much less capable than the big tech companies of actually harnessing and monetizing our data. Now, the Libra project also woke up central bankers to the very real risk that they might get left behind and fall short in their public responsibility to provide a form of money that can be used and that has the trust and the backing of the state. Just as central banks have a role to ensure that the value of their currency remains stable, they also have a responsibility to ensure that people can always have access to the money they need. A natural extension of that could well be that their money and their spending is protected from the commercial incentives of private companies, like that Facebook example we gave earlier. Now, central banks don't need to provide all the money in the economy to do this. They just need to have enough that the digital money provided by the central bank digital currency, is an always accessible alternative to give consumers choice. This also enables them to ensure that the value of £10 is always worth £10, always and everywhere, preserving something we call the singleness or the uniformity of money. It may sound strange, but different types of money actually carry different risks. When you hold and spend money in a bank account, you're entirely reliant on that bank remaining solvent over that period. The same is true for banknotes. That banknote could be worth less if the government defaulted on its debts. And it could be worth nothing if the central bank collapsed. In general, because the central bank prints its own money and has the backing of the state, it tends to be the lowest risk type of money to hold. And day to day, we don't really think about this risk at all. But we know that demand for banknotes rises in times of financial uncertainty, as we saw most recently during the COVID pandemic. Now, we have to remember that tokenized money is not an end in itself. We don't just do it for fun. We're doing it because it's needed to access the increasing array of digital assets that are available. In general, it seems that CBDCs will coexist alongside tokenized deposits issued by banks and stablecoins, each serving a slightly different purpose in the digital economy, offering consumers choice in how they pay, just as they have today. While central banks and governments might carry lower financial risk, many people around the world are worried about the government spying on them. The level of distrust in governments varies around the world, but you can hardly blame people for being skeptical when they see how data can sometimes be used by governments right across the world, from China to the US. And also when they see how some governments have acted to freeze bank accounts of people who are tied to certain causes, including in advanced and liberal countries like Canada. Now, there are many countries around the world exploring central banks. And the examples show how the design choices depend on the relationship between people and the state and the policy objectives of the government. In the Caribbean, for example, there was clearly a need to improve the distribution of money to remote islands to make sure people had access to the money they needed. Nigeria, meanwhile, has been battling with a number of economic challenges and wanted to provide an alternative to crypto, wanted to improve payments efficiency, both domestic and internationally, and wanted to reduce the amount of money circulating in the informal economy. To achieve that last aim, they also enforced a redenomination of banknotes. And we got to see genuinely what happens when you undermine trust in money. The combination of policies pulled at the very fabric of society, and we saw rioting in the streets as people were unable to use their own money to buy essential goods. China and India also wanted to provide an alternative to crypto, and in China they wanted to reduce the role of Alipay and WeChat Pay in a way that aligns with their approach to managing the economy. In India, Australia, and Brazil, there are clear attempts to make sure their innovation is future-proof, with Australia requiring interoperability with a developing stablecoin ecosystem, and Brazil seeking to support its growing digital asset economy, which led both of them to build on blockchains that could work with the Ethereum ecosystem. These examples all illustrate that there are a number of protections for citizens. Governance, first, including the rule of law and regulation. Second, policy, including societal norms and giving consumers choice. And third, technology, which actually can be used either to attack or protect citizens' liberties. And I will focus on the design choices through which blockchains and wallets can actually protect citizens' rights with a retail CBDC. Let's roll the clock back 6 years to 2018, when Bitcoin was going through a bull run and people quite rightly challenged whether the blockchain could meet the needs of the financial system. And they said it could not replace the traditional payment rails because it simply couldn't handle the required throughput. It couldn't manage because the transaction costs were too high and too volatile. Because institutions would be unwilling to hold something that was so vulnerable to cyber risk. Some were concerned about issues with energy consumptions, others about anonymity, and others still worried actually that it was too transparent for financial institutions to be able to trust that their peers could not see their transactions. But blockchains have moved on significantly in those 6 years. As blockchains have proliferated, they have tried to differentiate themselves with unique features that address these challenges. Some achieved lower transaction costs and gained traction in payments. Others built on top of the Ethereum blockchain ecosystem to achieve programmability and composability using smart contracts. Similarly, we have seen computational efficiency using proof of stake, shorter settlement times by reducing block lengths, increased transaction throughput, greater auditability and privacy using zero-knowledge proofs, permission zones, and layer 2 rollups. Many of the critiques that I had of blockchains as a regulator back in 2018 have indeed been addressed, including in the security that is used to secure those digital assets through companies like Fireblocks. In particular, though, I want to focus on the governance and privacy today, because I completely understand the reluctance of central banks to build on public blockchains when you're trying to build critical national infrastructure. But the development of composable blockchain ecosystems means that we can now have a layered approach that preserves the requirements of the financial system. So let's imagine a central bank operating a core infrastructure at the heart of the financial system. Because it is designed to serve as a platform for innovation, it is built on a blockchain. And because it is so central to the financial system, it is highly permissioned and strictly governed by the central bank. This blockchain uses the latest capabilities in zero-knowledge proofs to ensure transparency between counterparties while preserving privacy from others on the network and providing visibility to the central bank for monitoring and regulatory purposes. Because it's not designed to do everything in the ecosystem, it is built on interoperable technology and standards and designed to deliver cross-chain composability. In a second layer, Bank A, for example here, operates a separate blockchain, which includes all of its participants. It is responsible for the operation and the governance of this second layer blockchain, subject to the rules set by the central bank. In the same way as before, using the latest innovations in zero-knowledge proofs, it delivers transparency between counterparties without revealing any of the details to their peers on the network, so that it can meet its, without revealing any details to the peers on the network, which provides privacy. It also gives visibility to the operator of the blockchain, in this case the bank, so that it can meet its responsibilities for anti-money laundering and fraud monitoring. And because the central bank is one step removed, we can guarantee privacy for the individual consumer from the eyes of the government and the central bank. If each of the participants in the top layer central bank blockchain also operates a second layer blockchain of their own, it builds into a neat system of permissioned and public blockchains. It can define clear perimeters for governance, with clear responsibilities for the operators of permissioned blockchains. The system can use the central bank infrastructure for settlement between chains and in real time. And it offers connectivity and composability with the public blockchain ecosystem, with all that has to offer in terms of access to tokenized assets. So having discussed the blockchain architecture and why this can work while maintaining the requirements of the financial system, let me turn to the wallets. And what I believe is one of the missing pieces, the final pieces in the puzzle, in the transition towards what we call Web3, the direct ownership of data, content, and assets. In a technology setup that we and others in the market offer today, we can give customers direct ownership of their funds, protected by a triangle of trust. This triangle of trust is incredibly powerful because it offers resilience to operational and financial risks. And nothing gets a regulator more excited than operational and financial resilience. The customer in this setup is responsible for remembering their password and keeping their device safe and updated. A wallet provider provides a user-friendly interface and is responsible for customer onboarding, fraud monitoring, compliance, and handling customer complaints. And a technology provider is responsible for the infrastructure that holds it all together and the cybersecurity that helps protect the individual's private key. Now, if the customer loses their password, forgets their password, or loses their device, they can turn to the wallet provider, much as they do today, and they can go through a password recovery process to re-establish control of their wallet. Equally, if the wallet provider goes through an outage or an operational failure, the customer can turn to the technology company. It can go through a key recovery process, again, to re-establish control of their wallet and take it to another wallet provider. And if the technology company goes through a prolonged outage or a significant operational failure, they can turn to a third-party disaster recovery service, much like an insurance service, to re-establish control of their assets again, and then take them somewhere else. What's really powerful about this setup is that the customer has no financial exposure to any of the other parties in the setup. The customer has direct ownership of their funds in all these scenarios. This is clever because it separates very clearly financial risk from operational risk. It means that the wallet provider does not need to be regulated like a bank, and it can have a very thin requirement, meaning there are lower barriers to entry and exit, ensuring competition and consumer choice in the market for wallets. It also means that the customer can hold all sorts of digital assets in this way, including all the forms of tokenized money we spoke about earlier. And if we give the customer access to a retail CBDC, they can also hold the lowest risk asset in the land to minimize their exposure to financial risk. But they also have choice. So they can choose whether to spend in CBDC or tokenized deposits or stablecoins as they see fit. A true vision for Web3. I started this keynote with a quote from the great Yuval Noah Harari. I'll end with a quote too, this time from the children's TV show Bluey. In an episode about promises and trust, Bluey's mum says to her, "Without trust, none of this would be possible. No libraries, no roads, no electricity. And she was right. Our societies are built on trust, and money is central to that. Central banks around the world have the opportunity to upgrade our payments and financial systems for the future. Trust is hard-earned. And thanks to the private sector alternatives to CBDC, central banks will have to work hard to keep our trust, both in the value of the new forms of money they issue, but also in terms of the protection of our civil rights. But I have shown there is a way forward that leverages the latest advances in blockchains and wallets, and it can be achieved as a collective effort between the public and private sectors. Working together and underpinned by trust, we can continue to build amazing things in the future too. Thank you very much.
Varun, thank you. Where do we start? Any questions from the audience? Gentleman over there. Have we got a microphone that we can get to the gentleman over there?
That was really great, thanks. My question is about physical cash and where, what position or place do you think it has in a society that's moving towards, digital currencies and that sort of thing?
Great question. It's pretty informative to look at what the Bank of England here in the UK has said. And consistent with everything I just described, the goal is to give people choice, not to remove things, but give them more choice and see where they want to take it. What we've seen in the last 10 years is a rapid decline in the demand for cash for everyday purchases as people have started to use contactless more and more and electronic and digital wallets more and more. But that doesn't pervade to all parts of society, and it's very important that you don't leave people behind. I think cash has a role to play for as long as it's needed, and I think the Bank of England and the UK government have basically said as much, so that it's there as an alternative. And everything I've just described, it focuses on that point. Having consumer choice and having alternatives is really important to make sure you're not tied to any one, so that when one of the systems goes down, as they inevitably will, you have alternatives that work. You're not tied to the private incentives or even the government's incentives for any one of those payment methods, but we have choice, and that is really powerful for protecting our civil rights. So I think cash for the next at least decade will still be around in declining quantities, but I think people, as other forms become more and more useful, they will start to migrate. And it may be that a very small part of the population still needs it for a bit longer.
Varun, what role does Fireblocks play? Just go into that just a little bit.
Yeah, thanks. So what I described up there was the wallet infrastructure, and Fireblocks is a custody wallet technology provider. So one of the things we do is help people and institutions hold their digital assets in a very secure way. It uses a technology called multi-party computation so that no one's at risk of that single private key being lost. It's actually split into different parts, and that makes it very secure because it involves different parties in the system. And so what we're trying to do is make sure that central banks around the world, and this is the beauty of my role, I get to go and tell central banks around the world what is happening in the market, in the industry, and what are the latest innovations. And so I think we see our role as both advising governments and central banks on the latest technologies and taking the technology that has been developed in the market to the core of the financial system. And coming together with ideas like this to bring it all together and show them how this can actually be operationalized without building on technologies that are 10 years old, trying to get them in the right place so that it is future-proof and it is composable and it can do clever things as the system becomes increasingly interesting, effective, and I guess more intelligent. One of the really interesting things, for those of you that aren't in the industry every day, I mentioned the word smart contracts. And this is a technology that allows people to build programmability into the payment rail itself. Rather than a simple payment rail with a simple message on it, you can build programmability into it, like a computer system, so that you could have conditional payments. So you can have automatic payments. You can split payments. You can have taxes paid. You can split payments with your friends. But also that you could actually be future-proof and ready for a world in which AI agents maybe are operating on our behalf to book a holiday based on the constraints we've set them. And the really important part is that you can use these new technologies with the programmability you can build into them right at the heart of the financial system. So that we're not developing something really innovative over here, constrained by a really basic system in the heart of the system. So that's my goal.
And sum up in 10 seconds flat, which is grossly unfair, I see CBDCs as driving inclusion. And that will surely drive innovation in fintech. I mean, this has got to be one of the key levers to drive adoption and innovation in 10 seconds flat.
Completely agree.
Yes, excellent. Thank you very much indeed. That's the sort of 10 seconds I like. We've come to an end. Varun, thank you very much indeed. Just to remind you, this afternoon, if you're in London, not watching online, I'm afraid, 3 o'clock, it's free drinks. What's not to love about that? Followed by the FinTech Awards at 3:30 in stage 1. Please join us for all of those. And there's food and drink and entertainment afterwards. So just keep that in mind. For now, though, we're going to take a quick break. We're back in about 45 minutes here in stage 2. Varun, thank you very much indeed. Thank you very much.